I love the space right now because it has answered so many questions for me, especially for my relationship with my wife, on how we talk about money, on how we view money. All of the arguments we've had over the years, really, they're not about money. And for me, it's so much more fulfilling and rewarding to talk about that topic because then it blends into the family.
It is remarkable how important this topic really is, and how, I guess, neglected, or not even neglected. It's like almost intentionally maintained as people not having a good relationship with money, and it gets passed down from generation to generation, and there's lack of financial literacy. Hi everyone, I'm Jason Balara, and this is the Know Your Why podcast. Today I'm here with Gino Barbaro. He's an investor, a certified money coach, an entrepreneur, and a podcast host. Gino was actually on the show. I should have looked, but it's been at least 2 years. So a lot has changed in the investment world in that time. Gino, thank you so much for being here today. Thank you for coming back. I'm super excited to catch up, and so much to talk about. I'm sure it's always an ever-changing landscape. So thank you again for being here today.
Thanks for having me on, Jason. And I think I'd like to start out by saying, you say things have changed a lot. But when you really peel back the onion, to me, things appear to have changed, but it's just really the investing cycle in the market. They don't really change. They change from one cycle to the next, but I think history tends to repeat itself. And I think we forget that. And we look at things in a vacuum. We're only looking at the last 2 or 3 or 4 years. But when you go back into different market cycles where interest rates were higher, things are behaving as they were years and years ago. And I think I've got the advantage of having that experience. I've got the battle scars. So I've made those mistakes in previous market cycles. I'm no smarter than anyone else. I think I may be just a little bit wiser, and I may have a little bit more experience on my side. But that's the only thing I think that differentiates me from another investor, from a newer investor. I've just been through it, and I've been fortunate to have a really amazing partner, amazing spouse. So I've been through the battles. But I think the more things change, I think the more they stay the same, or that when you look at them, they're like, oh, that happened in the last market cycle. Does that make sense?
Yeah. Oh, no, it's a great point. I think when you sort of back up in terms of your view and look at it from a wider time frame, it really isn't that different. If you look at recency bias, interest rates were low and now they're high compared to that. But really, the abnormal part was those low interest rates. The really right now we're kind of sort of normal in terms of interest rates. And there was, I bought my first home, I want to say in 2000, and my interest rate was like 11%. That was just what they were. That was sort of normal at that time. And so I think, and I made money on that piece of property. So it's kind of like, it can still be done. I think sometimes the interest rates get overblown, but I love that point that it is not necessarily that it's, different right now. We are just in another cycle within the market. So let's tell people just a little bit, so they can go back and listen to the last one, but just tell people a little bit about kind of what you do, your background, and you can go real high level if you want, and then we'll just kind of continue from there.
Well, I was in the restaurant business for years, and I just got fed up. The Great Recession came in 2008. I had been investing in real estate by myself in 2005. I made a couple of big mistakes. And I look at that 2005, 2006 period as it seems like it was in the 21, 22, 23 period where things were really frothy. There was a lot of money. I had a lot of money. I invested in real estate, made all the mistakes that new investors make. And I found myself downtrodden, for lack of a better word. I was pissed. And I met Jake in 2009, my business partner. He was the pharmaceutical rep taking orders out of the restaurant. And I was the catering guy. I was the pizza guy. He was the drug rep. We partnered up in 2009, and we said, let's start looking at real estate. But we didn't start looking until 2011 when he moved down to Knoxville, Tennessee. We got serious. And it did take us 18 months to find our first deal. Now, for Jake, he's fortunate because I made all those mistakes. I bought at the wrong time. I didn't know the market cycle. I didn't have a blueprint. I didn't have buy right, manage right, finance right before I met him. I made so many mistakes. And when 2011 came, everyone's going to look back and go, well, that's when you should have bought real estate, because no, that's not the time you buy real estate, because interest rates were normal, but GDP sucked. Rents were terrible. The economy was terrible. You couldn't finance anything. There were deals everywhere, but you couldn't get a deal done. And it was very, very strange. I didn't know any better. All I knew is I wanted to get out of the restaurant and get into real estate. It took us 18 months to find the first deal. 3 months after that, we bought our second deal. And, last 15 years, Jake and I have been able to acquire over 2,200 multifamily units. We currently own 1,900. No syndications. We did a few syndications, cycled out of those, and now it's just our own capital. We're buying our own deals, and no right size, no right market. All we focus on right now is buying really good deals, focusing on how to buy these assets, how to finance them properly, and how to manage the assets. And understanding that buying multifamily, I think any real estate, whether you're buying a single family home or you're buying a multifamily or you're buying a self-storage facility, you're buying a future stream of revenue that needs to be managed. And it's the same thing as when you're buying a business. You need to buy it and finance it properly, but the managed right is where you're going to excel. Yeah. And that's where I think the last 2 or 3 years in real estate, I think the operations and the financing have been very, as we should say, suspect.
Yeah, no, absolutely. So, I mean, that a couple of really good things to talk about there. So, I know you have it, buy right, manage right. What's the third one? I'm gonna
finance right.
Finance right. So, we touched before we started recording, that can apply to essentially any sort of acquisition, whatever the asset class is, right? That all of those are the same core principles that you need to have to be successful in an investment. So you've cycled out of syndication and you're doing this yourself. Now that's different than when we talked last time. So that's interesting. I'd love to hear maybe just why, what's the thought process behind that, and what, I guess, do you think you'll syndicate again? But yeah, tell me a little bit more about why that's changed for you.
Well, in 2018, when we started syndicating, we ran out of money. I mean, it was basically a function of capital. When you refi $8 or $9 million out of the portfolio and you're continuing to buy, you're continuing to get money and putting it back into the business. And we got to a point where Jake, myself, and my other business partner, Mike, were like, hey, listen, let's start raising some money. Everybody's doing it. We have the Jake and Gino community at the time. We need to teach syndication. It's just another tool in the tool belt. We had done about $15 million of seller finance deals. We did a couple of master lease option deals. We did a bunch of partnerships and JVs. Let's learn this next strategy. And it was awesome because it really bridged the gap for us. We did 3 syndications, 2 in 2018, and I think 1 in 2019. And it really got us over the hump because in those next 2 years, we were able to continue to refi our portfolio. Now, I love syndication. It's a totally different business. So you're running your real estate business. Now you have this syndication business here. You've got to manage investors. You've got to manage assets. You've got to manage. It's a whole different process, right? And you got to do webinars, and you have another set of bosses, which is a good thing, and it creates its own challenges. Mm-hmm. When we got to that point, Jake and I said to ourselves, what is our core values? What do we really like, and what do we crave? We crave control. We carry responsibility. So for us, it's like, as a syndication, unfortunately, most people don't understand this. You're a fiduciary responsibility for the investor. You need to do what's best for that investor. Not what best is for Jake and for Gino. We want to hold these assets in perpetuity. That may not be the best thing for the investors. And we realize that. We're like, you know what? We need to cycle out of these deals. We need to get a great IRR. And by the way, those 3 deals, over 20 IRR for those 3 deals. Unfortunately, they were great deals. We just had to get rid of them because we had to actually, get that capital back to the investors and create a return. Now, the problem is we could have possibly refinanced 1 or 2 of them, but we didn't do the documents properly. And do our investors want us to refi these deals? We never had really crystal clear expectations on that. So it's another one of those things. Do investors want to hold on to these assets longer term? So we just said to ourselves, let's pull back. Let's figure out what works for us. What are our KPIs, our key performance indicators? And one that we really love is what we call PPU. We want to focus on profit per unit. That's what one of our metrics are. And if you're syndicating deals and you have less equity in these deals, well, obviously there's going to be less profitability. And so for us, we said, let's go smaller. Let's acquire between $15 and $20 million worth of assets a year, but it's all of our equity. We're vertically integrated, so we have a management company. That's another aspect of it where we can't outgrow our infrastructure. So it's like we don't need to buy 1,000 units or 2,000 units a year. I think people really miss this, Jason. If you're in the business for 5, 6, 7, 10 years and you do 1 or 2 deals a year, at the end of 5 years, you've done 10 deals. You've had hundreds of units. For us, for me, for my values, that's more than enough. I never wanted to have a portfolio of 6 or 7,000 units. I wasn't built like that. I didn't need that. And I started to understand that, well, that's where syndication leads you to. You're starting to scale. You're starting to get bigger. And with that comes a lot more challenges, a lot less control. And I just did not want to be on investor calls all the time. I didn't want to continue to grow the investor base. That wasn't where my passion was. So I said, let's pull back. Let's see what works with us. We love to manage our own properties because we have control. We love to buy really good deals within 3 hours of Knoxville. We have a really strict buy right criteria, so we can't get a ton of deal flow. And we buy really good quality deals that know that fits our criteria, that we're able to buy, we're able to refinance these deals and continue to hold the deals. So I know it's a long answer, but if you're out there, I'm not saying syndication is great or it isn't, but why can't you learn how to syndicate some deals? Why can't you learn how to possibly do a smaller JV deal? Why can't you go out and do a seller finance deal? It's just one tool that worked really well for that part of that market cycle. Now it's more challenging to raise capital. It may be harder to syndicate deals, so you maybe have to look at other strategies or other markets or other niches to make your investments work.
Are you planning a remodel or construction project? Overwhelmed by the process? Over budget? Extended timelines? Strained relationships? We are all too familiar. At Lark Construction Services, we help homeowners and business owners take control of their construction journey, from reviewing bids and contracts to catching red flags before they become costly mistakes. Our Clarity Audit is a one-on-one expert review of your plans, estimates, or current progress, giving you the peace of mind and a defined action plan to move forward with confidence. Don't let confusion lead to costly errors. Visit larkconstruction.com and schedule your free call today. Lark Construction Services, saving you time, money, and stress.
Yeah, I mean, so many good points there. I think a lot of it points to creativity. You talked about all the creative structures that you had, kind of early on with seller financing and master lease and all kinds of things like that. And now there was that time the market was so hot, capital was really inexpensive, you could leverage high. Like, it made sense to just take conventional lending. Yes. Although even that got some people in trouble because leverage was so high, and we got in a position of people were doing a lot of floating rates. And so when you have a cycle shift like this, it does maybe reestablish the ability to get creative. There weren't really,
yes,
when everything was so hot, like sellers didn't need to do seller financing. That's right. Because people could get 3% interest debt on that property. It's like, well, why does the seller want to hold the debt for 3% or less than that? So it didn't make up. But now, when your debt might cost, 7, 8, 10%, depending on the loan structure, a seller financed deal can be a lot more appealing to both sides. And yeah, you can start to look at, different asset classes and be sort of, just like I said, creative about how you're going to make things work. And then whether you're syndicating or not, but I think some of that, their points about being able to control it, not having to worry about raising capital, because the syndication business being its own business,
yes,
is I've never really heard it put that way, but it's a great point, because each property, right? Each asset is a business in and of itself. It should have its own business plan. It should have its own it's going to have its own debt structure in most cases. Now, you may have if you have in-house management, you may have some of the back office overlap, but realistically, they're each their own, and it's the same. So the syndication part of it is management of investors, raising capital, all of that. So I think just great points, and frankly, I sort of share your, realization of those challenges that come with syndication. And if you're not passionate about raising capital and being with investors, then maybe it's not the right space. The other thing is, and you touched on this, is the time frame. We already kind of talked about the benefits of stepping back and looking at things from a longer time frame, But most of the time in a syndication, or realistically almost any like private equity type structure, things like a lot of fund or syndication structures are meant to be held for 3, 5, 7 years. And even on these apartment complexes, the debt is typically not longer than 10 years. So if you want to hold on to things for a long term, it kind of doesn't work. It's just not, the vehicle is not set up to be run that way. And so it's set up to have turnover of capital. And so, yeah, I mean, if you want full control and virtually all the upside, and you might have to go a little bit smaller, but I mean, 100% of 20 units versus maybe 10% of 100 units, like there's arguments you could make either way. So I completely understand why, sort of you've made that, I don't even know that it's a return to basics, or return to regression to the mean, as the rates have done as well. You mentioned a quote before we started recording, and thought it would be a good thing to talk about. Would you repeat that so people can hear it, and then we can kind of get your thoughts on why that resonated with you?
Well, for me, I'm a big Zig Ziglar fan. I love Zig. He actually pulled me out of a dark place back in 06 and 07 when I was losing my mind, and I'm thinking to myself, I made so many mistakes. And just to hear his Southern drawl and to hear him say, if you aim at nothing, you're going to hit it every time. And it's so important to focus on something. And I went through this at the restaurant. When I was there, I didn't want to be there anymore. And I would say to myself, well, Gino, what do you want to do? And the answer was always like, well, I don't want to be here. But that's not the right answer. Like, what do you want to do? I know you don't want to be, but what do you? And that's the thing. What was I aiming at? I was aiming into the wilderness. If you don't have a target, you're never going to be able to follow. And maybe you may not hit the target, but at least you're aiming for something. Yeah. And I realized early on, I had gotten into a mobile home park. Then I got into a mixed-use building. Then I got into a strip mall retail. Do you see, like, I'm not really aiming at anything. I'm just trying to take shots in the dark. And that's what I think beginning investors do when they make mistakes, is they're like looking at a deal. I need a deal. I need a return. They're not really aiming at something specifically. And if you're out there and you're getting into real estate, just don't worry about what the niche is. If your friends told you mobile home parks are the best thing since sliced bread, or you got, retail is really great right now, or data storage is great right now, or industrial is great right now, I would just say, what's your relationship with money and what do you like? I liked multifamily because it was a basic human need. I had owned duplexes and triplexes. I liked the customer service aspect of it. I liked the stability of it. I liked the monthly recurring revenue of it. So naturally, when I met Jake, I'm like, bro, let's stick with multifamily. Oh, so now I've got a target. Now the target's multifamily. Now I really need to take a deep dive and learn about multifamily, understand the lingo, understand the business is what it is, and don't quit after 6 months because you haven't found any deals or there's no deal flow. Because in every market, you either have deals or you have capital. It's very rare that there's a convergence of having deal flow in capital. That may last for 6 to 12 months. I think probably in 2015 and 16, there was like a little bit of a glimpse of like some capital and there were still deals. But once 2017 and 18 came, all of a sudden the deals started becoming less because you have cost segregation, bonus depreciation's coming. All of a sudden people are seeing these tax benefits. So capital is flowing into that asset. And as that happens, cap rates compress, prices drop. All of a sudden deals start going by the wayside. So for anybody out there, if you're struggling with anything, that's the problem. We do not lack the clarity. People always say, what's the quote? The other quote that I love is, we don't lack the motivation. We lack the clarity. And once again, going back to that quote, if you're not clear on what you're trying to aim or try to achieve, it's not that you're lacking motivation. You just know what step to take. And getting back to the buy right, the manage right, and the finance right. Find a framework or a process or a system that works for you and learn how to follow that system. It takes away a lot of the downside risk. And it really, as Jake likes to say, it keeps you within the guardrails. We've passed on, hundreds of deals in the last 2 or 3 years. Get there, itis? 21 and 22 were tough for us. We didn't do that many deals. But thankfully, we didn't do that many deals because no deal is better than a bad deal. It's one of my, I guess I love to preach that, because if anybody's been in real estate for any extended period of time, they've probably lost money. And if you haven't lost money, you haven't been in it long enough. So I know the pain of that. And I know what I was telling you before. I've been in it long enough to have enough experience and have enough wisdom. Not that I'm any smarter. I just have made a lot of these mistakes. And I always joke around, Jake's lucky. He hasn't lost money in a real estate deal yet because he caught me at the right time. I had made all those mistakes for us before he joined our partnership. And he's just been very diligent. He's an excellent student, excellent learner. And now we are very selective on that. That's why with the syndication model, you may be hungry for a deal because you've got investors that want to place the capital. And you're afraid that, hey, you may lose those investors. Well, I don't have that pressure as much anymore to do a deal. I'd rather do a really good deal. 1 or 2 good deals a year is life-changing for us. I'd rather do 1 or 2 excellent deals than do 3 or 4 marginal deals.
Yeah. And yeah, no deal is better than a bad deal. That's a very, very true statement. You mentioned, you ask people, what do you want? And I think it's true. A lot of people can't answer that question. They can tell you what they don't want. They can say, I don't like my current job. I don't like my current, position in life, whatever it might be.
Yes.
But that doesn't, that to me, that your addition of that to that quote makes it more meaningful, because now it's like, well, sure, you don't, you got to aim for something, but you really do need to aim for something. You can't just be running away from something. And
Yes.
So having that clarity of what the goal is will help at least move you in the direction. And then just, we've mentioned it a number of times, but like expanding the time horizon. And as you said, don't quit after 6 months of not finding a deal. It's probably a good thing that it took you 6 months to find a deal, because that means you're not just taking whatever deal and not just trying to get one done. So it's, and the so wisdom from people who have lost money in real estate. That's a great, use those teachings from the people that have been there. So tell me about Barbaro 360. Let's talk a little bit about that, because I know family is very important to you and very important to me, and a lot about what or a lot of, where my focus and motivation come from.
Once I left the restaurant back in 2016, I moved to Florida. I was thinking of expanding the portfolio here in Jacksonville. Our portfolio is in Knoxville, and I just didn't like the deals down here. Unfortunately, I wish I hadn't listened to everybody living here that was saying the assets were overpriced. They basically doubled in 3 or 4 years. But hey, that's God didn't want me to buy assets in Jacksonville. So I was bored. So I said, what do we do, Jake? What do I do down here? How can I add value to the partnership? He's like, let's start a podcast. Let's write a book. So that's how Jake and Gino was formed, just by me wanting to be productive and wanting to learn how to become a much better investor. So over the years, we just continue to grow the platform. We've gotten a bunch of deals through the Jake and Gino community from the brokers that we've met and from all the events we've done. But at a certain point, as the education was going, I just felt less and less fulfilled about teaching people about buying real estate. I saw people that should be doing deals not doing deals. And I saw people that had no business doing a deal closing deals. I'm like, what's going on here? Like, what's the missing link here? And it just dawned on me one day about a year ago as I was selling the platform. I'm like, I want to get out of the education space. I just don't like it anymore. And I just figured out it's a person's relationship with money. That is what's holding people back. And I started down that road of becoming a certified money coach. And I got to tell you, I love the space right now because it has answered so many questions for me, especially for my relationship with my wife, on how we talk about money, on how we view money. All of the arguments we've had over the years, really, they're not about money. Money's a symptom. It's the cause. But if you dig down a little bit deeper, there's other stuff going on. And I was fascinated by it. And for me, it's so much more fulfilling and rewarding to talk about that topic, because then it blends into the family. Because the way you talk about your kids with money, it's all of a sudden, wow, they're going to grow up and they're going to adopt your patterns and the way you've spoken around money. And I could see what happened with myself, looking back and doing the work on myself and all of that development. My mom said things about money that, obviously came into my life. And how can a guy who's been in the restaurant business for 20 years have one restaurant? Then I meet a jabroni like Jake Stenziano, and within 5 years, we have over 500 units. It makes no sense logically. I didn't get any better or any smarter. I just subconsciously or unconsciously divorced myself from that mindset, and I met Jake, and all of a sudden, we're doing deals. I don't have that mindset of limiting beliefs. It doesn't take money to make money, right? Money doesn't grow on trees. Well, actually it does. It's called the refinance and roll. It's called the seller financing. Doing an $11 million seller finance deal with no money out of your pocket, it's possible. But when I had the restaurant, there was no possibility or no likelihood, because those were my patterns. Those were my beliefs. And once I started looking at that, Jason, I think to me, everything changed. Everything started clicking. So my passion right now is we want to change the world one family at a time. We want to help families talk about money, because it's one of the last subjects that everyone is just so fearful of. You hear about money and everyone just puckers up. We talk about everything else in society, but when it comes to the subject of money, the emotions around it are just incredible. And people's beliefs about it, whatever way you fall on money, it's a reflection of how you were raised, or maybe what you're running away from, right? Maybe your parents were terrible with money and you're like, I'm never going to go back to that. I'm going to become rich and I'm going to crush it. Well, is that a healthy way to look at money? I mean, ultimately you may become rich and wealthy, but are you happy? Is that the way to grow the business? And for me, I've seen a lot of people get into real estate for the wrong reasons. So I said to myself, should that person even be getting into real estate? How is that person's relationship with money? And how can we help families really bridge the gap of having really great, honest, transparent relationships with money? And also with couples, having that financial intimacy, having couples really talk about money in a cool way, open and honest way, and having them explore ways that they grew up around money and sharing it, and then saying to themselves, well, let's create a plan. Let's have open dialogue on how we can proceed forward talking about money in the family.
Yeah. It is remarkable how important this topic really is, and how, I guess, neglected, or not even neglected. It's like almost intentionally maintained as people not having a good relationship with money, and it gets passed down from generation to generation. And there's lack of financial literacy training in traditional schooling. I mean, there's just so many different things, and it's like, I mean, I grew up not having money. I don't really remember conversations around it. I remember the conversation is, we can't afford that, or we can't afford this, or what. I remember that. And it drove me, I think, to work hard so that I could have things, and afford to, but at the same time, it didn't teach me how to actually work, or actually approach from a abundance mindset. It didn't teach me how to have those conversations with partners, my wife, whatever, our kids now, like all of that stuff is just so important. I hope that it's a more prevalent topic now than it used to be, but even still, so many people, even adults, the ones that sort of need to be the role models for kids, are afraid to have those conversations, they're afraid to say that they don't have money. They're afraid to say they have a lot of money. There's just it's kind of like everybody just doesn't want to talk about it. And it's kind of an interesting divide that exists almost like subconsciously in society in general. And
think of how crazy that is. We get up in the morning, we've got to put food on the table, we've got to pay our rent, we've got to get gas in the car, but we don't talk about it. We homeschool our kids, and I was having this lesson last week with my two daughters. One's a senior in high school and one's in ninth grade. And I had already done a T12 lesson, so I'd already gone over income and expenses. So they already understand that whole process, the balance sheet, the income statement. So they're already at a high level with that. Last week, I taught them about budgeting, but I didn't want to call it budgeting. I said, here is your cash flow plan, because your language becomes your experience. And if I want to go down the conspiracy hole of why they're not teaching kids about money, to me personally, they're creating employees and they're creating slaves in the system. That's my own opinion, but let's put that aside. I want to empower people, and I want people to, it's really simple. It's not hard to teach kids. I showed my kids the budget or the cash flow plan. I said, girls, here's $5,000 a month. We're not going to do a pay yourself budget, because pay yourself budget, you're going to put away a certain amount of money to pay yourself first. That's what you could do as well. But let's do a $5,000 budget, and here are all the different items. We're going to put away 20% for housing, 10% for charity, whatever it came down to. And then at the end, I want 20% for savings as well. So they're seeing all of the items. It's like, okay, first of all, I can control my money, right? That's, nobody is really taught that, right? It's your cash flow plan. It's your plan. They get to the part where there's debt. And I'm like, a lot of people in this area right now have student loans and have car payments and have a lot. And they're like, wow, there's no more money left in the budget. I'm like, yes, that's the realization. So should you go to college and get a ton of debt and come out when you're 22 or 23? I can't answer that. But just to have that conversation and let them make the decision. And it's funny because my 18-year-old is like, wow, how do people make enough money? And I'm like, Veronica, that's what's going on. A lot of people don't make enough money, and they're struggling, and they're overspending. And why is that? It's coming back to the patterns, the behaviors, the dopamine effect where, hey, it feels good to spend money, and they don't even know why, and it becomes habitual. And having that cash flow plan and understanding it, the answer is not to cut up the credit cards. The answer is to understand why you're spending that money, getting to the root cause of it, and then trying to work through all of that emotion, and then trying to come to an understanding that, yeah, I can control it, and I want to be able to control it. And just having them go through that little plan completely open up their eyes. And I'm saying to them, I love debt. I have a ton of business debt. I have zero personal debt. And I love for all of my children to sort of mirror that, because you lever your business portion of your balance sheet to pay for the personal. I mean, it's really expensive to have credit card debt. It's really expensive to have a car payment. And people may be saying, well, I mean, I got to drive a car. Listen, I was 38 years old. My father had just passed away. It was the Great Recession. I literally, for the next 8 years of my life, was driving hand-me-down cars. I got his car for free. 4 years after that, that car died. I actually got my mom's gold Lexus. Wasn't a sexy car, 177,000 miles. But you know what was sexy? Zero payments. I spent like $2,000 in 4 years on that car to fix the air conditioning and something else. But you have to do that, right? And you have to understand that. And so for me, I could sacrifice short term for long term, but having kids understand that having these conversations is important. And once again, I'll say it again, your language becomes your experience. If you don't talk to your kids about cash flow, about debt, about income, about operating expenses, fixed expenses, if you don't talk about the CapEx, if you don't talk about all these things, they're not going to know. And it's a shame, because when they get to become adults, they can't even open up a checking account. They don't even know what that looks like. It's so sad. And I just hope that people start having these conversations. And it's okay that if you're not making a lot of money, be open and honest with your kids, because is it better not to talk about it at all? Because then kids can feel, they can understand something's going on. If you're avoiding the topic, then they're going to become adults and they're going to be avoiding the topic as well. And they're not going to be able to understand what's going on in their life.
Yeah. Yeah. I'm so happy to hear that you're educating people in this. And that's what I try to do, that to some small degree with podcasts. I try to do that, with my own family. My kids are young, but it's I think the thing is, like, if you listen to what they say, I think that they'll tell you what they think about really any topic. But realistically, It's like, my son's 6 now. He's old enough that he wants some things. He sees things his friends have and whatever, and he's like, I want to have whatever toy or something. And it's like, okay. And he's like, can you just order me that on Amazon? But he doesn't. Sure. But he doesn't know that the things we order on Amazon, we actually have to pay for them. Like, it's not just Amazon's really, really nice and you tell Amazon what you want and they give you things. And I think there's like plenty of adults that almost look at it like, I just single click buy now, and here I have this thing that I want. I would say, always, it's hard to think of a case where this wouldn't be, but in almost all instances, you can make more money. In almost all instances, you can spend less money. And I think that that's the decisions and the mindset that have to be made in, if you're in a scenario where it's, finances are difficult, those are the two options: make more or spend more. Make more or spend less. Those are the two options. And I would say you can always do at least one of them, and probably you can do both of them, but it means some level of sacrifice, and that's hard for people to, I think, maybe wrap their minds around in some instances. And so,
Jason,
it's a tough spot.
What I would do with your young child, because young children don't understand, this worked really well for me. I just did the jar system. And you have to teach kids that there's a finite amount of resources, whether you're a Jeff Bezos or whether you're making 30 grand a year. It's finite. So what I would do is I'd have 3 jars. I'd have one for saving, one for spending, and one for charity. Make it real simple. The kids need to see the money. That's the other issue.
Yeah.
They see the money, and then, hey, you want to buy something on Amazon? Here's the spending, and maybe you could put $50 in there for them.
Right.
But let them see that. Okay, that's going to Amazon. Money is gone, right? As long as they can see it. Something else that I love to do early on, I would go into the grocery store with $100. Let's go shopping. No credit card. Now, all of a sudden, we only have $100 to spend. Now the purchases become very, very finite. I can only buy whatever I have with $100. And that's why credit cards, they can be challenging for young kids because they don't understand the difference between credit and debit. My kids know that a debit card is coming directly out of your account. A credit card is money that somebody's lending to you at no interest, but you're still going to have to pay that back in the next 30 to 60 days. So going into it, it's like mental gymnastics. It's like a homeschooler's dream to have their kids go in there and to figure out, what can I buy with $100, $200, whatever it is. And they're doing the math and they're figuring it out. And when you get to the counter, you've overspent. You've got to take some things off. And that will really, I think, set them in the mindset that, wow, no matter how much we have, we still have a budget. We still have a finite amount of money that we need, that we can spend. And hey, let's direct it. That's what the cash flow plan is all about. You're trying to have your kids become intentional with spending their money. And also, any kind of leak will sink even the greatest ship. And that's what happens with most adults. We have these little leaks, these little pin leaks. And then all of a sudden they become bigger and bigger and bigger. And before you know it, you're underwater. I'm trying to teach my kids to avoid that and to say, hey, whatever amount of money you make, just please understand that you have the autonomy and the ability to direct that money in any way it can go. Just understand that you have the decision to make. And whatever decision you make, it's yours. It's based upon your values and where you want to spend the money.
Yeah. Yeah. That's great. Great points. Great points. Well, Gino, this is a topic that I am very passionate about, so I could probably talk to you about all day, but I won't keep you all day. And I want to make sure I get to ask you, and I know I asked you this last time, but I do ask every guest, what is your why? And I think I'm guessing we've probably talked to some degree about, what that is for you, but I want to give you the answer give you the chance to expand on that question and kind of what's meaningful to you and kind of what keeps you going. You've had a lot of success already.
Well, I see how when people interact with our family, they're just happy. They're joyful. They can't figure it out, like why they want to continue to hang out with us. And it sounds a little crazy, but I can't put my finger on it. And then I say to myself, we're just a regular family. We just love each other. We love to hang out with each other. And I want to promote the family. That's what I want. I want to have a father and a mom who just are together and are going to struggle. They're going to argue, but there's a foundation. And I think kids need that. And I really want to promote dads, and I want to promote really the family. That's what keeps me going, because I've seen the success that we've had, and I love watching our kids grow, and I love being able to promote them, and I love being able to tell them, hey, do whatever it is that makes you happy and whatever lights you up. I got into real estate to make money, to become financially free. And then once you become financially free, you're like, well, there's more than just to making money. That's the irony in life. We're all out there trying to make a ton of money. And then when you have your 100 units or your 200 units or your 1,800 units, it's like, okay, that's great. What's next? And I realized that every entrepreneur that has been successful, there's that what's next. And then what you realize is whether you're Elon Musk, whether you're Jeff, it's all about really serving others. It's really about providing value. And I think that's what my wife and I sat back and said, well, how can we help others? We love what we're doing. We love our family. There's people out there that are trying to build a family. There's not, I wouldn't say there's a lot of role models, but I really want to shout from the rooftops. It's really cool. Family life is awesome. Married life is awesome. Is it hard? Yes. But is there anything out there that isn't hard that's worth it? And I think the answer is no. And so for us, really changing the world one family at a time, talking about money, having those conversations between husband and wife, and really trying to share that with family members, I think to us is is really sparking our passion right now.
Yeah, it's amazing. Well, I'm sure that's going to resonate with a lot of people. When they hear this and they want to connect with you, what's the best way for them to reach out?
I would say 2 sites. You can still go to jakeandgino.com. We have our podcast on there. We have some resources on there for the real estate. If you go to Barbaro360, Barbaro360.com, that's where we have all our podcasts as well. I actually do a podcast with my son. He's 23 years old. We have the Happy Money podcast. We have the Julie and Gino podcast as well. So if you want to go out there and start listening to a couple, we interview all thought leaders, business leaders, Dr. Gary Chapman, all different authors and writers. And for me, it's just a great show. It's just another way to amplify the message and to say, hey, it's okay. If we love working together. And that's another place where I'd like to say, husbands, wives, it's a great place to get connected. And why not? If you're thinking about working with your spouse, why not?
Yeah. I agree. My wife and I work together, and it's great. It's great.
Yeah.
It's funny. We don't fight about work. It's really actually a great thing for us. So
that's awesome.
Well, Gino, thank you for coming on the show today. This has been amazing. We'll make sure we have those resources for people in the show notes to connect with you. But thank you for your time. Thank you for sharing everything you did. I really, truly appreciate it.
I appreciate it too, Jason. Take care. Thanks.
Yeah. Folks listening, make sure you connect with Gino. Please like, rate, and review the show so we can continue to get great guests. And thank you all for listening.
Hey there, I am Dr. Jason Balara, and this is the Know Your Why podcast, where we explore the why behind success. Every week, I meet with real estate investors, veterinary entrepreneurs, mindset coaches, authors, and fitness professionals to uncover their why and how it drives them on the winding road to success. What is your why?